Hello. Before we dive in, I want to acknowledge that this material was prepared with the support of AI to help synthesize the information, and then, of course, it was carefully reviewed for accuracy. All right, let's get started. Welcome, everyone. Today, we're going to explore a really powerful financial strategy for Canadian entrepreneurs, and that's smart income splitting. This is so much more than just a simple tax trick. It's really a sophisticated method for optimizing your family's overall financial health and ultimately preserving their hard-earned wealth. So let's just start with a fundamental question. For a lot of business owners I speak with, the answer to this is surprisingly often yes. The whole goal of our session today is to explore the legitimate, strategic ways to make sure you're not leaving money on the table with the CRA. So, what is income splitting at its core? Well, think of it as a strategy designed to work with Canada's progressive tax system, not against it. You know how it works. The more you earn, the higher your marginal tax rate goes. By strategically shifting some of that income to family members who are in lower tax brackets, you can significantly reduce the total tax the entire family unit pays. It's about looking at the family's tax bill as a whole. Here's a quick look at our roadmap today. We'll kick things off with the opportunity itself, then tackle the absolutely critical TOSI rules. You don't want to miss that. After that, we'll walk through 3 different kinds of strategies, and then we'll wrap up with some clear next steps for you. So, who really stands to gain from this? Well, the primary beneficiaries are business owners whose income puts them in a much higher tax bracket than other members of their family. That gap is where the opportunity lies. And the pool of people you can split income with is actually quite broad. We're talking about your spouse or common law partner, your adult children, that's anyone 18 and over, and yes, in some very specific situations that we'll touch on, even your minor children. It's really important to remember, though, that the rules and the opportunities are different for each of these groups. Now, before we get into the exciting strategies, we have to pump the brakes and discuss the single most critical compliance issue in this entire area. Seriously, understanding these rules is absolutely non-negotiable for implementing any of these plans legally and successfully. The government brought in what's known as the Tax on Split Income, or TOSI, specifically to crack down on what they saw as unfair uses of this strategy. And the bottom line is this. If you don't play by the rules, the income you thought you were cleverly splitting gets hit with a massive punitive tax rate that just wipes out any benefit you were hoping for. And just how punitive are we talking? Well, under the TOSI rules, that income gets taxed at the highest possible marginal rate. In some provinces, that's over 53%. This can completely destroy any potential savings. It's exactly why careful, professional planning and strict adherence to the letter of the law are just not optional. So, what kind of income does TOSI target? Generally, it applies to passive income streams paid to family members, things like dividends from your private corporation or certain capital gains. But here is the crucial part. There are specific, legally defined exceptions, and all the smart strategies that we're about to discuss, they're built around perfectly meeting the conditions for these exceptions. All right, let's move into our first playbook of strategies. These all involve direct payments to family members for how they're involved in your business. Let's compare the 2 main ways to do this, salaries versus dividends. Paying a salary is pretty straightforward. Your family member does real work for the business, and you pay them a reasonable market rate wage for it. The big plus here is that their salary is a tax-deductible expense for your corporation. Now, on the other hand, you have dividends. This means your family member has to be a shareholder. And to stay clear of those nasty TOSI rules, they need to be actively engaged in the business. The general benchmark for that is working an average of 20 hours a week. Okay, this case study shows a more advanced salary strategy. Let's imagine a father who's in the highest tax bracket. He pays his daughter $40 an hour for work, where the fair market rate is really $18. So that first $18 an hour, that's a normal deductible expense for the company. But the extra $22 per hour is not deductible. That means the company pays a little more tax. But, and this is the key, the entire $40 is now income for the daughter, taxed at her much lower rate, instead of being income for the father, taxed at his very high rate. When you run the numbers, you see that the personal tax savings for the father can be so much larger than the small increase in corporate tax, leading to a really significant net tax saving for the family as a whole. Now, beyond just direct payments, the way you actually structure your business can unlock some incredibly powerful income splitting opportunities that are completely exempt from the TOSI rules. This right here is one of the most powerful exceptions to the TOSI rules. It's called the excluded business exception. If your business can check all 4 of these boxes, you can pay dividends to a family shareholder, and they won't be subject to that punishing TOSI tax rate. This is an absolute game changer for businesses in fields like retail, manufacturing, or even restaurants. To make that first point a little clearer, just take a look at this chart. As long as your revenue from services is less than 90% of your total revenue, like it is here at 80%, the business can qualify. So you can see how a service business that also sells some physical goods could potentially meet this threshold. Okay, let's shift gears now from your annual income to a massive financial event, the sale of your business. If you're proactive about your ownership structure, you can achieve some truly monumental tax savings by using a tool called the lifetime capital gains exemption. As of 2024, the lifetime capital gains exemption lets every single individual earn up to $1.25 million in capital gains from selling qualified small business shares, completely tax-free. That's a huge number. And here's where it gets really powerful. By setting up a family trust to hold the company's shares, every family member who's a beneficiary of that trust can claim their own personal exemption. Look at how this multiplies. A family of 4 can suddenly shelter up to $5 million from tax when they sell the business. This is a profound wealth preservation strategy. All right, for our last set of strategies, we're going to broaden our view beyond just the business itself and look at personal investments and other financial planning tools. You see, these tools integrate your business planning with your personal financial goals. For instance, contributing to a spousal RRSP lets a higher income spouse build up retirement funds for the lower income spouse, which helps balance out your income in retirement. Or contributing to an RESP for your kids' education shifts investment income to them, so it's taxed at their low rate when they're in university. More advanced moves could involve using a holding company to stream investment income to family shareholders, or even gifting assets so that the future growth is taxed in your children's hands, not yours. We have certainly covered a lot of ground today, from direct payments to business structures to asset planning. The big question is, where do you go from here? And this is maybe the most crucial point of all. Everything we've talked about today are concepts and strategies. How they apply is incredibly specific to your business, your family, and your financial situation. Getting professional tax guidance isn't just a good idea, it is absolutely essential to navigate the complexities of the law and make sure you are 100% compliant. So I'll leave you with this question to think about. You now have a framework for understanding the immense potential of strategic income splitting. The next step is to take this knowledge and turn it into a concrete, personalized plan of action. Thank you for your time.